Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 2nd of April. I'm Daniel Lam, your host for the podcast. One of my chess mentors in my teenage years told me something that stuck in my mind. He said that a solid way of playing chess means your games are less likely to be super exciting. But that does not mean you got less chances of winning. So yesterday, we spoke about the potentially lower volatility on the rate space. But linking that up with my chess analogy, lower volatility does not mean fewer opportunities. Very often, trends develop more easily if the environment were calmer. In our latest global market outlook, we do see two areas of opportunistic buys in the developed markets bond space. The first one is the US inflation-protected government bonds. So this is a hedge against any revival of inflation. Our base case scenario is for the disinflationary process to continue. But we're also aware of the upside inflation risk from a prolonged resiliency in the US economy, higher oil prices, and any supply shocks. So the cost of hedging using US TIPS is lower relative to other classic inflation hedges. Now, gold is trading close to a historical high, while real estate is challenged by high rates and post-COVID shift in working patterns. Moreover, US TIPS offer a headline yield of around 4.6%, which is much higher than the yield of DMIG government bonds at 3.2%. Lastly, inflation expectations could overshoot in the near term, driving US TIPS higher. Now, the second area is European government bonds. Now, we did say yesterday that we see the US economy to be quite resilient and power back on our rate cut expectations. However, the story is somewhat different in Europe. We do see attractive upside potential in government bonds there because of a relatively weaker euro area. Now, the money market is pricing in about the same number of cuts in the euro area and the US over the next 12 months. But we see greater downside risk to the euro area economy than the US. The euro area inflation appears to be less sticky than the US as well. So putting all these together, there is a higher risk of deeper cuts by the ECB, which translates to higher capital gains for European government bonds. Now, for the dollar-denominated investors, the dollar hedge yield of European government bond index is also roughly in line with the US government bond index yield, which means there's no negative carry. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.